Hello, my name is Kyle Siren, Customer Risk Manager with Arden Mills Solutions. COVID-19 is affecting all of us, and this monthly video is no different. Due to social distancing, this will be a little different than the past videos. I am fully aware that a haircut is overdue, and I got my son assisting me on set. But hang in there with us. Market's been very active and volatile lately, so let's dive into this remote edition of the Inside Scoop. Welcome to the April edition of the Inside Scoop. On March 31st, the USDA released its quarterly grain stocks and planting intentions report. The planting intentions report is traditionally one of the most important reports of the year. Remember, last year roughly 15 million acres of intended corn and soybeans did not get planted due to the historically wet spring. These acres were anticipated to come back, and the USDA intended acres suggest just that. This graph combines corn, soybeans, and wheat planted acres. Do note, the 2020 bar shows intended acres. Over the past several years, it's been common to see 225 million combined yearly acres, and last year's planting issues are easy to spot. So what does the USDA think the farmers are intending to plant? The answer is corn. 97 million acres are the forecasted intended corn plantings, which would be just shy of a record, as you can see. We'll see if the farmer truly does plant 97 million acres of corn. These intentions were forecasted before crude oil went from $55 a barrel to $19 a barrel. Gasoline demand last week was almost half of that of a year ago. Some ethanol plants are not buying corn anymore, as making ethanol is no longer a profitable enterprise. On April 9th, the WASDE report showed that ethanol demand was lowered by 375 million bushels, which is a 7% decline for the marketing year. Depending on how long social distancing continues, there is a potential for this to decline even further. Corn prices are currently at their lowest levels since 2006. Nearby corn futures have held $3 since ethanol demand was growing back in 2006. With the potential for declining demand for corn and with intended acres to be at near record levels, it's difficult to think corn prices will rally significantly in 2020 like in the spring of 2019. What does this mean for wheat? The chart behind me is the Kansas City wheat futures corn futures spread. Last summer, the spread was as tight as 20 cents wheat over corn. Now it is over $1.60. Last year, when corn was getting expensive, livestock feeders could substitute wheat for corn in feed rations. This spread does have a fundamental arbitrage when it is low. Wheat can be substituted for high-priced corn. Wheat may be able to take some of the 97 million acres away from corn in 2021, but that is a long ways away. Wheat prices have firmed since the March Inside Scoop was sent out. This chart behind me is Kansas City July wheat futures. As you can see, Kansas City July wheat futures traded down below $4.30 a bushel, and since then have traded back over $5 a bushel for a brief period. When wheat futures were declining in March, the macroeconomic market at that time was in a risk-off mentality. This chart is the same as what we saw before, Kansas City July wheat futures, but the orange line is nearby crude oil futures. When Kansas City wheat futures traded down to its low on March 17th, crude oil was approaching $20 a barrel. So why such a big bounce? Well, let's start with that global wheat stocks are tight. Over the past several editions of the Inside Scoop, we have shown this graph. The 8 largest exporters export 90% of all wheat exports around the globe. Those 8 exporting entities are the EU, Russia, the United States, Canada, Ukraine, Argentina, Australia, and Kazakhstan. With global demand historically steady and inelastic, the available supply is normally what drives prices. As you can see, their stocks are very tight. When we take the United States out of the equation, you can see the other 7 major exporters have very low stocks going into harvest. This means 2020 production is more important than normal. U.S. wheat conditions are good, and there is rain in the forecast. There are some cold temps that could hurt the wheat crop, but this remains to be seen. In Europe and Russia, recent rainfall has been light. Forecasts are also light. This is getting the market's attention, and futures are putting in risk premium. Over the next few months, Russian weather will likely be the most important factor for the direction of wheat futures. Dry weather will likely boost wheat futures prices, and conversely, wet weather will likely push futures lower. There has been a political angle also to these markets. The graph behind me shows Russian wheat stocks to use ratio. With their stocks so tight, and with the ruble weakening versus the US dollar, which we'll show here in a second, there are growing concerns about food inflation and food security. So far, the limits on exports from Russia, Ukraine, and Kazakhstan have been minor. Limits so far are through June, just around the time of harvest when stocks will get replenished. But will politicians be even more cautious in this COVID-19 environment? We do not know, nor does the market, but it is a risk that is being discussed. All of us here at Ardent Mill Solutions hope that all of you are safe and healthy. COVID-19 has affected all of us personally and is an effect in wheat markets as well. If you have any questions on the wheat or grain markets, please do not hesitate to email me or call me. Thanks, and have a safe and healthy day.